what comes in precious metals this time around should dwarf what happened before. I mean, I think, $5,000 gold is completely possible in this next run, and that's only, 150%. That's not a huge, gigantic increase on the part of gold, but $5,000 sounds like a crazy number right now, but that's completely possible. And then for silver, just look at the gold silver ratio, expect the ratio to hold in its trading range, which means the gold silver ratio is liable to go from 80 to 40, which is how it normally works in precious metals bull markets. And that takes silver up into triple digits. So yeah, I mean, I totally think that's highly likely.
Frank Holmes, CEO of U.S. Global Investors, predicts a strong upward trajectory for gold prices in 2024, potentially reaching $3,000 to $4,000. This optimism stems from his observation of gold's resilience despite historically high interest rates, which traditionally dampen gold prices. ANZ Bank strategists have revised their 12-month target for gold upwards to $2,200 from the previous forecast of $2,150. A combination of easing monetary policy underpins this optimistic outlook for 2024, heightened geopolitical risks, and robust central bank purchases. The former Wall Street financial analyst John Rubino predicts a significant gold price surge, noting the 150% increase in precious metal markets. He also highlights silver's potential gains tied to the typical gold-silver ratio shift toward 40 in bull markets. The bullish calls on silver come as prices have managed to hold critical support at $22 an ounce and are ending the week testing initial resistance at $23.50 an ounce. The silver price ended the week at 7% from its lows. A high gold-silver ratio signals that silver is potentially undervalued, and in December, the number was 81 to 1, far above the modern average between 40 to 1 and 60 to 1. Since then, it has ratcheted up another 5 to 10 points, currently above 1 to 90. Drawing parallels with the 70s, Rubino points out short-term hurdles for gold and silver in the face of recession concerns. He believes Fed easing during economic downturns will benefit precious metals in the long run. After a hiking cycle that pushed the Fed funds rate to its highest in more than 22 years, policymakers on the Federal Open Market Committee, FOMC, have indicated at least 3 rate cuts in 2024, as inflation eases from the 40-year highs seen in mid-2022. Rising inflation pressures have taken their toll on the gold market. While a lot has been thrown at the precious metal, it continues to hold critical support, at least for now, according to some analysts. Now, we present the clips of John Rubino's insights from his recent interview with GoldSeek Radio. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Because once governments give up and start bailing out everybody in sight, then terrified capital is going to flow out of financial assets and into real assets. And gold and silver will be the easiest, simplest way for capital to do that until there's none left. When the door slams closed, then it becomes unobtainium, not gold or silver anymore. And that'll happen too. We'll have a time when go ahead and call your gold dealer if you want to, and they'll put you on a waiting list and take your money up front, and you'll sit there and hope they don't go bankrupt before they get you your Krugerrands or whatever. That'll happen. So, it makes sense to be prepared ahead of time. In other words, just get your stacking done now and then let all this stuff play out, and you'll be immune to most of the trouble that it causes. Well, in the 70s, inflation was way out ahead of everybody. The Fed was increasing interest rates to catch up to raging inflation. And so the gold market was focused on inflation. In other words, on the crashing value of the dollar. And interest rates were kind of a side effect of that, but people definitely bid gold and silver up through the roof. During the same time, rates were going up, but they were both happening because inflation was spiking. Now, this is not that kind of a time because inflation is, it's higher than it should be. It's up a little bit, but it's not terrifyingly high. And so many aspects of the economy are so weak that I would say we'll be in deflation in another year. Now, that's potentially bad for gold and silver in the short run because, a tip over into a recession that is actually deflationary is bad for stocks because that means corporate profits are going to go down because corporations can't raise prices. And we'll get an equities bear market. Now, that could suck gold and silver down in the short run. But remember, what an equities bear market and a recession and the danger of deflation all do is they incent the Fed to start easing aggressively. And that's when you get your, 100 basis point cuts in one Fed meeting kind of scenarios. And that's great for gold and silver. So, could be that we see another 2008 or 2020 situation where the stock market goes down and so does everything else, including gold and silver and the mining stocks. But then they bounce off of a V bottom and just head to new highs. That's what happened in both of those times. So, you could be caught owning gold and silver miners, for instance, when that happens, and you could really regret your choice to buy those gold and silver miners. But 6 months later, you're glad you had them because they went up so fast. So I think that's a possibility. It just depends on how far ahead the markets look. Because right now or lately, they've been expecting the Fed to ease. So they've been looking ahead to that easier money, and they've been buying stocks in the short run. But the same thing could easily happen. So in other words, I have no idea, what gold and silver are going to do in the short run. But I think there's an excellent case to be made that 1 year and beyond into our future, they're going to be in raging bull markets.
During the interview, John Rubino advised stacking physical gold and silver for a secure financial foundation. According to NASDAQ, silver is tied to the economy's overall health due to its industrial uses. The UBS report came after a report from the Silver Institute projected that global silver demand would increase to 1.2 billion ounces in 2024, a 1% increase. Regarding undervalued gold and silver miners, Rubino is optimistic about potential capital flows for their recovery, despite short-term equity bear market concerns. Amid growing supply constraints and undervalued stock prices, value investors gravitate towards mining stocks, seeking to capitalize on a market dislocation poised for a readjustment. Taylor McKenna, CFA analyst at Copernic Global Investors LLC, shared insights at a Benzinga virtual event on Thursday, highlighting the significant gap between metal commodity prices and the valuation of mining companies. Let's get back to the interview.
Well, it depends on your situation personally. Like if you don't have a lot of physical gold and silver, then that's your play. You should just be stacking, dollar cost averaging gold and silver coins and bars. Okay, until you have enough, what you consider to be enough for your bedrock basic financial life. You've got your real money. It's going to maintain its value going forward. And then you're free to branch out into slightly riskier things, depending on what you think is the most attractive thing in the intermediate term. And, gold and silver miners are really beaten down. They're incredibly cheap, both historically versus the stock market and versus the underlying metals. So I think that a lot of the gold and silver miners are probably, great intermediate and long-term investments. The short term, again, can't know that. We can't know whether they're going to get hit again. But I think over time, the fact that they're super cheap right now limits your downside risk and gives you a really big upside potential with them. So, and in fact, that's starting to happen. I think it was Stanley Druckenmiller, who's a major money manager out there, dumped some of his tech stocks and bought, I think it was Barrick. I should have read that more closely before I start saying it, but he bought one of the big gold miners to replace some of his tech stocks. And I think that's a reasonable thing to do now, and see somebody like him doing that gives the rest of the market permission to do it. And that's why gold and silver miners are up really nicely today. There's 3 or 4 that are up double digits in terms of percentage, which hasn't happened much lately. So I think that it's possible that it's kind of coming together for gold and silver because they're value plays right now, the miners are. And you can get value money managers moving into them. And the big value guys are very mainstream. So when other people see that happening, they start thinking, all right, maybe I want some Barrick, maybe I want some Newmont or GDX or something like that. So it's possible that that we get some capital flows based on valuation into the gold and silver miners, and that helps them come back relative to gold and silver, at least. In other words, they're super cheap compared to the metals, and if they just get back to fairly valued historically compared to the metals, they're probably up 30 or 40 or 50% in a lot of cases. So yeah, I like the miners. I worry a little bit about that equities bear market, but I do not worry about 2 or 3 years out with the miners. I think they'll be just fine by then.
The latest Kitco News Weekly Gold survey showed Wall Street and Main Street diverging once again in their price expectations, with many retail investors seeing potential gains next week. In contrast, analysts see a strong case for precious metal prices to slide. Considering the dynamic shifts in the economy, how do you envision incorporating precious metals into your investment strategy? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.